Barry, thank you so much for coming and joining me today. One of the number one questions that I'm getting today is, what is happening with interest rates in our market today? The fluctuations that we're seeing, they're up, they're down, they're moving sideways, and people just have a lot of questions surrounding that. And we've done a lot of business with you at East Wisconsin Savings Bank for many years, and I wanted to bring you in and have you talk with our buyers and sellers about what you see in today's market.
Yeah, the rates are definitely fluctuating. The media is talking about it. Rates are going up. The Fed just raised the rates 3/4 of a point, as you all know. They're talking about a couple more rate hikes as well. So a lot of people are nervous right now about interest rates, but they really shouldn't be. Historically, interest rates have always moved. And just because the Fed raises the rates, one of the biggest things that people make the mistake of is thinking that interest rates, if they raise them 0.75%, that the mortgage rates are going to go up 0.75%. But that's not entirely true. When the Fed raises the rates, it's the short-term rates. It's not the long-term rates. They do sometimes have an impact on mortgage rates, but I've seen mortgage rates go up when they raise them. I've seen them go down, and I've seen them stay the same.
So this just happened recently where we saw the Fed announce that rates were going up 3/4 of a point. And I know that there were some people that got really nervous and thought that immediately in their mind thought the mortgage rate is going to go up 3/4 of a point. What did you see happen actually, within the bank?
Interest rates did move a little bit. They did go up a little bit, but they were far from going up 0.75%. They did go up about a little over 1/4 to 0.5%. And then they adjusted. And just like we had talked about in our previous conversation, they adjusted down a little bit. So they went up, they spiked, they leveled off, and they slowly came back down, an eighth to another quarter. So I think they're settling in right now.
That is why it is so important when a buyer's out shopping for a home, in my opinion, that they work very closely with their lender, because you may have supplied them with a pre-approval letter and that may need to be adjusted based on the rate that's, offered at the bank on any given day. But you're an expert. You've been doing this for so long that you can really help navigate people through. Hang tight for a minute. Let's see if rates, bounce down a little bit or where they're going to be, or if you think they're going to trend upward, helping them lock into those rates as quickly as they can.
Yeah, absolutely. Rates are constantly on the move, and that's a good point, Tiffany. And we talk about this as well. When somebody has a pre-approval at a specific interest rate and interest rates go up, realtors and consumers should really get back with their lender and talk to them about the pre-approval to make sure that that pre-approval is still good. Because if the rate moves high enough, they might not be within the budget that they're looking for, number one, or they might not qualify for that loan. So it's very important in these times that you keep in contact with your lender to make sure that you're still within the guidelines of where you want to be personally and what you actually qualify for with the bank.
When we were talking before, you mentioned to me that on average, you're getting 1 to 2 mortgage applications a day right now, which is really great. That tells me something, Barry. That tells me that people want security. They want security of home ownership. So when we talk about what are interest rates doing in today's market and how is it impacting the market, we're still seeing buyers buying. Buyers want the security of a home. The other thing that I know in 2 decades of selling houses is that people want options. When it comes to selling their home, buying a home, they want options. And one of the things that I love that we've talked about is you've introduced me again to the adjustable rate mortgage and what that can do for a consumer. Tell me just a little bit more about that.
The adjustable rate is a very good option. Now, don't get me wrong, the 30-year rate is still a great option for some people out there that want the 30-year rate. Historically, even with rates where they're at today, they're still historically low. But there is an adjustable rate mortgage out there that I've been talking about for several months, and we've obviously talked about it, that can allow people to get into that home they want and stay within their budget and be at a rate that's affordable for them and their family versus the 30-year rate with little or no risk to that rate changing, obviously within a specified period of time. And it's a really good option for people right now.
And sometimes that can be almost 2% difference between a 30-year fixed and an adjustable rate mortgage, which can be a big savings.
It is. Today with rates, it's exactly a 2-point difference on a 7-year ARM versus a 30-year fixed. And the savings are significant on a monthly basis. But if you look at those figures and those savings over the first 7 years and the amount of money you save versus a 30-year fixed, I think a lot of people are trending towards an adjustable rate mortgage, and now the mainstream media is starting to catch on to it, and they're starting to encourage people to do it, where you and I have been talking about this for months because we're always trying to find ways to help our customers and make sure they're getting a good value.
It's an option, right? So it's an option that we can provide the consumer to say, do you want the 30-year fixed, which is less risk, right? Or do you want the 7-year ARM, which comes with a little bit more risk if you don't intend to stay there long term? Well, one thing I read just recently and somebody wrote was, marry the home, not the rate, right?
Right, absolutely.
We know that house prices are never going to likely go down maybe more than 1 or 2%, right? So if house prices are going to continue to climb, marry the home today, get the best value you can out of the house, and then let's talk about the rate and the payment. Because as I mentioned earlier on, a lot of people buy on payment. And it's really, really important that we help them understand, if this is the home you love, here's how we can get you into that home for that payment. And I know you brought an example that you wanted to share with me as well.
Yes, once you see the example, we can take, for example, a $300,000 home, and we can look at the difference at a fixed rate mortgage versus a adjustable rate mortgage. And the savings are significant.
Let's take a look at that.
On a $300,000 loan, Tiffany, at 6.125%, the principal and interest payment is $1,823. Take that same $300,000 loan at an adjustable rate of 4.125%, and that payment drops all the way to $1,454 a month. That is $369 a month in savings. And if you multiply that over 7 years that the rate's in effect, that's over $30,000 in interest savings. Think about what a family could do with over $30,000 in savings.
That's a significant amount of money.
It is. I mean, if you take that on a monthly basis, you could use that extra money to pay off higher interest credit cards. You could take that money to invest in your retirement. You could also take that money and apply it to your mortgage because you were going to pay a 30-year fixed rate anyway, right? Apply that to the mortgage. So now you saved $30,000, but now you just paid off $30,000 of principal off your loan in 7 years. The effect of an adjustable rate in this market right now is absurd. It's just an amazing option.
Absolutely. So I know the number one concern for people is going to be, at the end of 7 years, what happens to my interest rate? Can you just explain that to us a little bit?
Well, we know, how long would you say the average consumer stays in their home?
8 to 9 years.
8 to 9 years, okay. On a 7-year mortgage at East Wisconsin Savings Bank, at our bank, we are a little bit different. So the rate would be locked in for 7 full years. So you would be at 4.125 for 7 years. The most that our rate will ever adjust after that year is 1% per year. So in year 8, you would go from 4.125 to a maximum of 5.125. You're still 1 point lower than what you would have been 8 years prior. In year 9, it's at 6.125. Now you're equivalent to the rate that you would have been paying from day one had you not taken an adjustable mortgage. So in a 9-year period of time, you've saved thousands of dollars. There's no prepayment penalties. You can refinance at any time. And obviously, if you sell, all that money that you saved goes into your pocket.
That's an awesome option. I love this for people, that they have the option to do this to keep things affordable for them and make good, choices for their family.
Absolutely. I mean, it's really a great amount of money to save. And at the end of the day, whether you choose to do a fixed rate, some people don't have the tolerance for adjustable rates, and that's completely understandable. But if you look at rates historically, where they've been and how they've moved, you could also go from a 7-year ARM. If rates go up a little bit, you can refinance on another 7-year ARM, which will obviously be lower than the current market rate. So the risk historically is really low, in my opinion.
Now, we've been talking about rates today and how to get into a home and affordability and how to make that happen. But there's a lot of buyers in our market that are just frustrated. They've been out shopping for a home for a year and they kind of got knocked down, right? Like, they got rejected offers because they were offering over asking price, no home inspections, and they're frustrated and maybe sidelined. And I'd like to pick this video up with you, if you don't mind, and do a second segment about the frustrated buyers in our market and bringing yourself back to the market. Put your toe back in the water, so to speak, and get out there. Is that cool with you?
Absolutely. That's a great conversation we really should talk about.
Let's do that.